Hello viewers, welcome once again to our channel. Who doesn't want to invest in multibagger stocks and make 1 crore with just 1000 rupees, right? Everyone does. One can achieve this by investing in multibagger stocks. These are equity shares of those companies that generate returns multiple times higher than their associated acquisition cost. These are companies with tremendous growth potential, sound management, good production techniques, and generate excellent research and development that allows their products to create high demand in the market. Multibagger stock gives us return several times the amount we have invested, and they are stocks of companies with strong financial performance. It should have capable management, robust cash flows, and a good capital allocation strategy. The term was introduced into investing by the legendary Peter Lynch in his 1988 bestseller One Up on Wall Street. Lynch was a baseball fan and he borrowed the idea of a multibagger from baseball, where bags or bases that a runner reaches are the measure of the success of a play. Some of the best multibaggers in the last 10 years have been alkyl amines, Tanla platforms, Deepak nitrate, Kaplan point, HLE class code, Uno Minda, to name a few. Let's now focus our attention on how the anatomy of a big multibagger looks like. Here are some key pointers borrowed from a book called 100 to 1 in the stock market. A potential 100 bagger stock must be small. The headroom for growth is the most important factor in choosing and finding a multi-bagger stock. It said, it said that a shark in a fish tank will grow only 8 inches, but in the ocean it will grow to 8 feet or more. The shark can never outgrow its environment. The same is true when identifying companies. Look for a small fish in a big pond rather than a big fish in a small pond. Look at companies which are small but growing and gaining market share in industries which are expanding. The second point is it must be relatively unknown. Popular growth stocks may keep on growing, but too often one has to pay for expected growth too many years in advance. Thirdly, it must have a unique product that would do an essential job better, cheaper, and or faster than before, or provide a new service with prospects of great and long continued sales increases. Finally, it must have a strong progressive research minded management. But how do we identify such companies when they are trading at such a low price and can be a multi-bagger in the future? Well, there are seven factors which could be handy in identifying these multi-baggers. Capable and strong management. Management is the backbone of any company without which without which no business can succeed. One should look at various aspects when analyzing the management of any company, such as corporate governance, pledging of shares, board independence, discipline regarding financial matters, and so on. Strong promoter holding. Promoters are the people who start the business. So, if the people who started the company do not remain committed to growth and default, there is no point even at evaluating businesses. While looking at multibaggers, it's important to focus on the jockey more than the horse. As the horse gets more familiar with the racetrack, his performance is likely to increase. But during the initial days, it's the jockey who is going to train him. Likewise, it's the promoter's business acumen and the fire in his belly which will drive and steer a small company, and that is what you must bet on. Competitive advantage or moat. It is one of the crucial factors when it comes to analyzing any company. In order to grow in the future, a company needs to keep on improvising and introduce new products in the market. So, to check whether a company possesses a competitive moat, one needs to see how innovative the company is. This can be done by analyzing the research and development, patents, and how often they launch their products and services. Good earnings growth. One also needs to check whether the company is growing every year. So, when we look at the earnings, we should see whether the earnings are growing or not because of its profitability model, revenue growth model, or capital allocation model. High margins. When looking for multi-bagger stocks, one should look for businesses with high margins. These stocks usually have sustainable growth over time and don't fluctuate so easily. Allocation of capital. These companies usually have internal funds for expanding or launching new products. They also have low debt level against equity and generate free cash flow. This cash flow can be used for future expansions or to pay dividends. The most important element in finance is the cash which a company generates and not profits. For a small company, what is important is cash flows and not profits. Debt is fine, but debt beyond a limit becomes poison. While I understand some companies need to grow rapidly and debt is a way to fuel the expansion, I have seen the smartest people too failing in life due to debt. A company which expands using internal accruals and limited debt is a classic precursor of a multibagger. Now, there is one quality which supersedes all of the above. If you don't have that all, the above is meaningless. And that quality is holding on to your conviction during downfall or market crashes. Growth potential. The company should have overall good growth potential. The management should be very vocal about its vision and should be able to explain the steps for achieving the same. In life, your plans are the key to achieve your goals. The same is true with companies. I'm talking about the capex which a company is undertaking. Whenever a company thinks it's running short of capacity and demand is exceeding supply, it will undertake expansion. As an investor, you should find companies in the process of building capacities or have recently commissioned them. The incremental growth is likely to come from these new capacities. Also, while doing this, you should be wary of companies which undertake expansion by raising too much debt. A mix of debt and internal cash flows is fine. However, too much leverage could invite disaster if the industry slows down. One of the tricks of owning multibaggers is that you have to be invested in the stock and be patient. When invested in that stock, you are always tempted to sell the same. However, you should be patient and make the right decisions at the right time. Multibaggers take time to compound, and if you interrupt the power of compounding, the multi in the multibagger goes away. I have seen people create a fortune by holding on to Wipro shares which they had purchased during the IPO. A few thousands have grown to crores of rupees. And mind you, this is after Wipro underperformed for a long period in the early part of this decade. Their conviction has paid off. And that's the power of patience, compounding, and conviction in your ideas, which creates multibaggers. We hope you found this video informative and use it to its maximum potential in the practical world. Also, show some love by sharing this video with your family and friends and helping us in our mission of spreading financial literacy. Thanks for watching. Until then, have a great day.